Nobody will turn up until 5 minutes past anyway. Let's see. It does say we're live, but I have no idea if we really are or not. Let me refresh the page.
YouTube has a countdown for one. I think actually it does. YouTube just changed it.
Well,
yeah, I think we're actually on.
I'm seeing an ad at the moment.
Yeah, click
there we
through
go.
that and you'll see us. Hi, everybody.
Hey guys, all three that are watching at the moment. I thought I saw like 10 on there, but
if anyone could please leave a comment just to see that you're here and we could read comments. Appreciate it. Started a little early just to make sure that'll work.
Raj says, nice hair, Russell.
But Raj, what about mine? I'm not going to duck.
Hey, Cody, I sent you an email, I think, earlier. Your subscription on Sidekick Traders didn't work or something, so I think it's you, right?
Hi, Cody.
By the way, this is my hair really short. Normally it's like a huge like afro, so.
My forehead looks nice because of all those stuff I put in my brain.
Hey, Hodges, how's it going?
Well, welcome everybody. Yep. We're trying out a new program for live streaming, and it should actually come in on Facebook and YouTube. If you're sub to Stock Alerts channel, you should be able to see it either place.
So far, it's only YouTube comments. I can see where they're coming from on the StreamYard thing. Can you see that too? Or
yeah, I see the YouTube comments.
Yeah.
I haven't tried Facebook at all to see if it would work.
Hey, Matt, how's it going? Matt is in the house. Let's see if the donkey Marion makes it, or if Malcolm makes it, or see. There's not a huge amount yet. It's pretty much 8 o'clock though, so we probably just get started. There's 14 people now coming in. Come on, people, more than that. We had like 50 left. Should we just start and get going?
Yeah, let's get started.
And you know, if they're late, they're late. So they get what they get. All right, do you want to share your screen then?
Yep.
People still coming in. Okay, I need to add that to the stream. And then I'm going to just maximize you, not you, the actual PowerPoint. There we go.
Yep, Russell, you'll be in charge at this point because I can't see comments because I'm on full screen on the laptop.
All right, no problem. I'll keep you updated. There's pushing 20 people in already, so let's just get going. There'll be more people as you know.
All right, welcome everybody. If you do have any specific questions, we'll do this in the end of the presentation, but definitely leave a comment whenever or question you're having as I go through any of the slides. So we'll have a Q&A afterwards. Just wanted to do a quick introduction. I'm Lance Kaminsky, and I've been doing stock trading for decades now, almost 20 years, ever since college. And I've been primarily focusing on selling options in the last few years. I primarily do cash secured puts, and we look at way out of the money put options, typically with high implied volatility. And I did a previous video, was it a week ago, I think, or 2 weeks ago, where we looked at why selling options and how to set up a cash secured put and whatnot. But there was a lot of questions after that video on what can we do when the position doesn't work our way. Like sometimes the stock will go way under the strike price. And then we're going to look at 2 main strategies that you could use. The wheel strategy involves selling covered calls. And then another strategy is to just manage your trades by rolling your puts down and out. So down in strike price and out in time. This presentation is available. Oh, you might hear my cats fighting. Sorry about that. This presentation will be available. I left a comment for the PowerPoint there. and you could refer to these notes as you need to. So let's go over what the wheel strategy is. We're going to do covered calls first and then rolling puts after. Essentially, when you start the wheel strategy, typically you're going to sell a cash secured put on a stock. Man, my cats are really fighting. Okay, sorry. So you can sell a cash secured put on a stock, meaning you're going to put up the money to be able to buy 100 shares of stock at a certain strike price. And we're selling this put, meaning that we're going to be collecting or taking in premium. When you're assigned, you will then sell a covered call, and we'll go over what the parameters on that is. Essentially, you're willing to sell the stock at a different strike price when you already have the 100 shares. And then if the shares are called, you would repeat this wheel strategy over and over. You could sell another cash secured put at the same stock or use a different position, whatever you see fit. So some of the benefits to the wheel strategy: if you want to buy a stock but the current price is a little too high, wheel strategy could be good because you're going to be collecting those shares a little bit lower than the current share price. In most cases, you're going to be selling the puts at a delta of about 30 or so. If you want consistent premium payments, so you want to be collecting money every week, every month, and it's a good way to have cash flow into your accounts. And also, if you think a stock will not move too much up or too much down, depending on the position. So wheel strategy is pretty useful for relatively lower implied volatility stocks where the share price is not going to fluctuate dramatically up or down in a certain direction, but you'll be able to collect premiums on both sides of the wheel, selling those cash secured puts, and then when you get assigned, selling those covered calls. So the basics of the wheel strategy: usually you're going to start by selling a cash secured put. Typically you want to find a stock you either wouldn't mind owning or you really want to own, where you could actually have enough in funds to buy 100 shares of the stock. Because when we're doing options, I was looking at 100 share increments. You're going to sell a cash secured put, in many cases, 30 to 45 days out, although it's not set in stone. You could do this in a week if you'd like. And a delta of around 0.3, I think that's a good cushion where it's a little lower than the current share price, and you could get a good premium out of it. It's kind of the best of both worlds. But again, this number is not necessarily set in stone either. You could sometimes go lower or higher deltas if you want to own the stock. One of the key things I'm going to mention quite a bit in this is to write down your cost basis. Your cost basis is essentially the strike price that you're selling your cash secured put in, and then you're going to subtract the premium collected. So for instance, if you sell a cash secured put with a $10 strike price and you earn 80 cents in premium, you could do 10 minus 8, and your new cost basis would be lowered because you're bringing in that premium money, and it'll be $9.20 in this case. Now, next step in the transaction. Let's say the cash secured put does not get assigned. Again, strike price of 10, and let's say the stock hovers near 12 or so and never reaches 10. You get to collect that premium, and then you have your money available. You could do another cash secured put over and over again. Just keep collecting that steady income. Now, if you do get assigned, let's say the stock goes under 10, then what you could do is essentially turn the wheel and then do a covered call with this strike price over your cost basis at least. And we'll go over a few situations on how to determine the covered call strike price. So let's go over more about covered calls. When you're assigned shares on a cash secured put, selling covered calls will earn you premium on the shares you now own. You're essentially renting out your shares from someone else. The way that a covered call works is you already own 100 shares of stock, then you're willing to sell those 100 shares to another party at a certain strike price. Okay? So essentially you're renting it out, doing it as a loan, and you want to be making these covered call strike prices at a price you're comfortable with selling. It's one of the key parts where some people, beginners especially, they might be selling covered calls way below their strike price. And then in that case, you're actually locking in a loss in that case. So you could sell covered calls at the same strike as your cash secured put if you'd like to. In this case, you would receive premium from the cash secured put side You'd receive premium from your covered call side. Both directions, you're receiving money. If the stock drops quite a bit, you could still sell covered calls lower than that original strike. But again, I'd highly recommend selling above your cost basis, because in that case, you would still earn a net credit, net profit in the transaction. And if you're a little more bullish about the position, you could even sell your covered call above the original strike. And in that case, you might have possible capital gains. For instance, previous example, let's say you sell a cash secured put at 10. Let's say it gets assigned to you, but then you think that the stock's going to go up and maybe make 15 or so. So you might be able to sell a covered call at 15. If it shoots up to 15, you just made a $5 difference from when you sold the shares at 10, since you bought them back at 15. It's a $5 difference in strike price. And you would also receive premium for doing that covered call strategy. So here's an example I put with numbers on a covered call, and we'll look at an actual example I traded with. So let's say you get shares assigned on a cash secured put at 10 strike price, and you earn 0.5, that would be $50 in premium. You then sell a covered call, and let's say we sell it a month out at the same strike price at 10, and you're again collecting money on the other turn of the wheel, collecting money on $40 in premium. In this case, let's say the stock does shoot up to around $10.50 the next month. You are obligated to sell your shares at 10 though. However, you received $50 in premium from your cash secured put side. You received another $40 in premium from the covered call side. And remember, 10, you didn't have any difference in the share stock price. So all your profits would be the premiums collected. In this case, you could take your 50 plus your 40, and you would make a $90 return on your $1,000 initial investment. This would be a 9% return on your money. So these could be very valuable strategies to earn a pretty good premium on. This is an actual example of a covered call, and it's actually still going on in my personal account. So this is CCIV. It's now LCID, I think. Lucid for electric vehicles. They're trying to be similar to Tesla in the high-end electric vehicle market. Here's a share price in the picture, as you see from March to currently. On March 26th, I sold a cash secured put at the 26 strike price, and I was assigned. And it happened fairly quickly. Ever since that, I've been only selling covered calls. I didn't ever lose my shares. I didn't roll or any of that fancy stuff. I've been simply selling covered calls from around here all the way to currently, and I still have one. The stock actually reached a low price of $17.45 near the middle of May. So it was a pretty big jump, pretty big decrease from the 26 where I started all the way down to the 17.45. And as you can see with the share price, the stock's been hovering kind of almost in a support level in the low 20s. Normally, if I'm at 26 and I'm just waiting for it to come back up, I'm not going to be making much money here. But as you'll see, by selling these covered calls during this whole transaction, I was able to lower my cost basis quite a bit from that initial 26 strike price. So by selling, sometimes I sold some weekly covered calls, sometimes I sold monthly ones, depending on what the share price was doing. I did the covered call strike prices at different amounts as well. I'm not going to go over every single one of those because there's quite a bit. But if you do join Theta Traders, you'll be able to see all the transactions I made in the spreadsheet that we have. I was able to very greatly lower the cost basis. I was actually able to take the cost basis down $6.13 times it by 100, $613 in premium I've received already from March to today, just on this one position. To find the current cost basis, you take your 26 strike price, you want to subtract all the premiums that I've collected, and then my new cost basis, $19.87, which is much lower than the initial $26 cost of the shares when I had to buy them there. I do currently have a covered call. I did a weekly covered call on Monday that's going to expire this Friday, and it's going to pay me $14 in premium for just 1 week time. And I actually sold this covered call at the same 26 strike price. So if I happen to get a sign and it goes to 26 and change, I'd be out of this transaction at that point, and then all my gains would be from 26 to the full premiums collected. Selling weekly covered calls right now at this 26 strike price is earning about 0.5% return on my money every week. Now that could change depending on what the current share price is. A few weeks ago, it was really close to 26, and I was making much bigger premiums then. When the share price was in the 17, 18s, I wasn't making too much then, but still at least 0.5% a week, it's 2% a month. That's going to beat the S&P 500 pretty much every year if you could continue doing that. So that's essentially what covered calls are. Next main strategy we're going to go over, how to roll down and out on a cash secured put. This is a little bit different than selling covered calls. So let's say you're doing a cash secured put and you don't necessarily want to get assigned on the stock you have. What you could do is called rolling the cash secured put, and you're going to roll the strike price down and out in time. And ideally, you do this for a net credit. You want to be collecting, bringing in more money than you're spending to essentially get out of the initial position. So let's look at an example again. We sold the same cash secured put, 10 strike. Let's say we initially collected $50 in premium for a stock. Let's say it started at 15 and unfortunately it dropped down to 9. What we could have done before in the wheel strategy, just let you get assigned at 10, sell covered calls back at 10. And that's one of the main strategies to do. But a second strategy that you could do, instead of being assigned these 100 shares, we could essentially get out of the original cash secured put. This will have to be for a loss because the share price is lower than the 10 strike price. So the initial transaction would be a loss. However, we're going to sell a new cash secured put out in time and down in strike price. Okay. So for this example, let's say the premium for the cash secured put to buy it back, buy to close, let's say it's 1.3 or $130. Again, that would be a net loss initially because you only collected 50 and you're having to spend 130. But what we're going to do is we're not out of the transaction completely. We want to sell a new cash secured put at a lower strike price. We're going to sell it at 9 instead of the original 10 strike price. And then maybe we'll be able to make 1.4 in premium. So we're selling a new position at 1.4, which is a little bit greater than what we had to buy to close the original at 1.3. It'd be a $10 net credit in this transaction, and you lowered your strike price down a whole dollar. So let's figure out the new cost basis on your shares. Again, the notes are given to you if you want to look and deep dive into this a little bit more. Original strike was 10. You collected $50 in premium. Your cost basis would now be $9.50. Let's say you buy back that cash secured put at 9.3. Then our cost basis will be $10.80. If you stop here, you are at a loss. But now we're going to sell a new cash secured put at 9. We're collecting $140 in premium. The new cost basis would be 9.5 here. Add the 1.3 for buying that original position. But then subtract 1.4 because we're collecting money. We're lowering the cost basis. Our new cost basis would be 9.4. Notice that that's a little bit lower than the original 9.5. In this case, let's say that the stock hovers around 9, and then in the end of the second transaction, let's say it goes to $9.80 or so. In that case, the cash secured put would expire worthless. The net premium you would receive was 0.5 for the initial. Subtract your 1.3 for buying to close it. Add 1.4 for the new position. Add all that up, you return $60 in premium, which is a 6% return on your money, even though the stock might have been getting assigned to you and it dropped very quickly. So if you're assigned on the Kesker put at 9, another good benefit is your cost base is still 9.4, which is lower than your original 9.5 cost basis. Another benefit is you lowered your strike price from 10 to 9. You get an extra $100 to maybe do another trade with. So it lowers a little bit amount of risk because you have less money into the trade completely. Here's an actual example I'm using currently where I rolled down and out. On July 1st, SPCE, they're the space company, not the Russell guy that flew out into space. I forgot the name of the company. But they went out to Virgin Galactic. Yep. They were at $44.60. I decided to sell a Kesker put that was in the end of July at $31. So I tried to pick a strike price much lower than the current price. I did collect $132 in premium. Unfortunately, the stock kept dropping, unlike the rocket ship that actually went up. And it was actually down to $28 in middle of July. So it was lower than the strike price that I initially started with. In the middle of July, I decided I'm going to buy back this put. I was a little worried that it might keep dropping to the 20s or 10s. So I actually bought back the put at $303. But then I sold a new Kesker put out to August 20th. I lowered the strike price from 31 to 30. Again, going down and out in time. So I'm going a month out again. And I collected $368. I collected more money than it cost me to buy it. And I lowered the strike price $1. So again, I was able to roll down $1 and out a few weeks. And I still received 368 minus the 303 or 65 extra dollars in net credit that I could use whatever I want in my brokerage at that point. Currently at close today, it is at $31.40. So it's a little bit higher than my new $30 strike price. The premium is right now $196. I could decide to possibly buy to close this at this point, but the $196 could easily drop quite a bit in the next few weeks. So I'm going to wait on this position right now until when it's closer to the expiration date of August 20th. And then I'm going to look to buy to close this particular transaction for a net profit on the whole thing. Okay. I don't know exactly what I'm going to buy to close it at. Depends on what it's looking like. There's a chance I might just let this get assigned and then I could sell covered calls, just like the first strategy we did in the wheel. Or maybe I could roll down and out again and possibly get a lower strike price and still collect money. And the goal is to be collecting money constantly, getting net credits, possibly being safer on your money. And then eventually, when the transaction ends, you can end up with a pretty good profit, even on companies that are not doing so well and they're dropping a lot more than you expected it to do. So here's some of the benefits between rolling down and out and covered calls. I hear this question quite a bit. Which one should I do? Should I roll it or should I get assigned? There's not a clear yes or no answer to one or the other. I think it depends, but here's some of the advice that I usually give. For rolling down and out, you do have a lower strike price, a little safer because you're using less money in that transaction. And you're using your less buying power. You started at 10, go down to 9. You're using $100 less in that transaction. And if you're getting a net credit when you're rolling down and out, you lower your cost basis even more on that position than you had, just like we saw in the examples. There are a few negatives to rolling down and out compared to covered calls. Rolling down and out typically, not always, but typically lowers your returns than getting assigned and selling. This would be selling a covered call, not a cash secured put. Typically, the wheel strategy will usually make a little bit more money if the stock comes back up to that strike price. You do lose some what's called theta decay. Theta is a number that shows approximately how much the premium will go down per day, assuming the stock and the implied volatility doesn't move at all. So you'll lose some of this when rolling because you usually roll a little bit early. You could sometimes roll the day of expiration. But if you just let it get assigned and do a covered call, you do get the theta decay of the whole initial catch your put. And you do have more time for the position to move. Sometimes you might have to be patient and wait a few months before you can get out of the transaction. Here's when I decide to roll down and out or sell a covered call. Pretty basic, straightforward, and this depends on your perception of the particular stock you're doing this transaction on. I think in general, if you're more bullish on your position, if you think that the stock's going to go back up relatively quickly, just let it get a sign and sell covered calls on it. In many cases, that's usually more profitable than rolling. If you don't particularly want to own the stock, if something might have happened with this company and you're worried that it might continue to decrease, then in that case, usually rolling down and out for the net credit is beneficial because in that case, again, you're using less funds. It could be less risky on that transaction. These are not hard and set rules. It's really up to you as a trader to decide if you're more bullish or not on a stock that's not going your way. So conclusion, selling covered calls or rolling your cash puts down and out will lower your cost basis. And that's one thing that you guys should be looking at is what your cost basis is. I always track what my cost basis is whenever I'm about to sell covered calls or roll, because you don't want to accidentally sell a covered call lower than the cost basis. You're actually locking in losses at that point. It can also possibly get you out of a losing position at a profit. Right now with Lucid, I could actually get out with a profit if I wanted to, but I'm just going to decide to continue to sell covered calls on that one. Now, quick plug here. If you would like to cast your put recommendations, I look for recommendations on stocks that are relatively high implied volatility. They're pretty far out of the money. So again, $44 strike. I'm selling cast your puts down to 30. Big cushion there from the current share price to the strike price. We also do a private Discord, pretty active in that, and we have quite a few members already asking a lot of good relevant questions there. There's a free strategy ebook where I go into a lot more detail on selling covered calls, rolling, how I look for positions. We also do talk briefly about other strategies like poor man's covered calls, doing credit spreads. Also, if you want one-on-one help from me at any time, I'm pretty active here, so if you have a question, I usually get back to you relatively quickly. If you want to, you could join ThetaTraders with a Z.com. And right now we have a 14-day free trial. Just test drive it out, see if this might be something that you might be benefit or might be helpful to you. Okay. So that's my spiel. How's everybody doing out in the chat here? Russell, you're muted.
All right, is that better?
Yes.
Good. All right, cool. Well, let's do some questions and stuff and see if we can get some arguments going.
Sure. Russell, it's up to you how you want to ask them based on the chat, and then I can just answer them here.
Yeah, can you see the comments on the?
I can see the question. Yeah, I see the comments.
Oh, okay, cool. All right, guys.
You want to just start from the beginning?
Yeah, go for it. Yeah, I was just kind of responding to some of them, but not all of them. So.
All right, let's see. 806. How do you say that name? Gren Fajid Hodges. I'm sorry if I mispronounced your name. Stupid question. Don't you have to own shares of a stock in order to do covered calls? Let me first say that there's no stupid questions. Some options could be very tricky and challenging, so I don't mind that question at all. In order to sell a covered call, you're right, you do have to own 100 shares of stock. If you're not owning 100 shares of stock and you're trying to sell a call, that's called a naked call. And friends don't let friends sell naked calls. That is a very risky proposition there. But you're right, you do have to own the shares. Okay. Is it Yahya Jabber? Again, I'm sorry if I say your name wrong. He said, good representation, but you don't sell cast your put something on something you don't want to own, such as AMC, just because the IV is high. That's a pretty preconceived notion that a lot of traders think of. And I understand why they think that way, and I don't necessarily blame them for it. A lot of people could do really well selling catch your puts covered calls on stocks that they love and own. And I am doing that with some of my positions as well, but not necessarily just because the IV is high. You are right in that point. The higher IV positions do give more in premium, and they are usually a little more tougher to manage and to deal with. But there are a lot of opportunities to make really good returns on these. I wouldn't necessarily sell an at the money put on AMC for a month out.
No way, like,
Super risky there.
death on a stick, though.
Right. And you wrote, why not? Maybe it isn't the safest strategy, but you sell far enough out of the money, then is it that worrisome? That's a good point. So if the IV is high, implied volatility essentially means, let's say my head is the current stock price. If the IV is high, there's a wide range of values that the stock might be within that time period. If it's a low IV, it's really narrow range. Obviously, in the very high range, it could drop a lot compared to a low IV. But if the IV is like this, and we're selling Kester puts even further out at good support levels, it could still be a very good profitable trade. If you know that the stock's like this, and then you sell a Kester put around here, you're probably not going to earn that much. So again, it's up to you. I'm not necessarily saying it's wrong to only sell low IV positions because some people do really well with it. But I personally have been doing very well with selling on the high IV positions. Raj wrote, agree, go way out of the money on a high IV stock, collect money for providing insurance to the other guy. That's exactly how we make money. Yep, exactly. Chan Chu Tan says, how would you know in a month's time it'll be 1.4? The price will move. No, you're right. I just made number of examples that could have worked, and they have worked in a lot of the positions I've seen. I just wanted to be able to show what the cost basis was in those. Just a quick answer to the premium. It depends on the implied volatility. If that decreases, typically the premium will decrease. Also, the share price, obviously, how far in the money, at the money, out of the money it is. So there's a lot of factors at play there. So I can't really give a quick answer on that. He also wrote, I learned the lesson the hard way. There's always a safer way. Yeah, sure. There's plenty of safer ways to do this. I typically, and on Theta Traders, we recommend doing at least 10, possibly even more than 10 different positions at any one time. You know the term, don't put all your eggs in one basket. You want to spread out your positions to a lot of them. And most of the positions I do, the initial cashier put usually ends up buying to close at a profit. We're going around 80 to 85% of them are doing that already. The other 20% or so, you do have to do some of these management strategies. But if you spread it out amongst a lot of different positions, the winners are going to offset the losers, as you might notice when you're trading, right? I'm just passing by an attorney billboard saying, one call, this is all, and even AT&T, 99% win rate.
Yeah.
It'll be good to have a 99% win rate and never have to worry again, right?
Right. Except the one loser just wipes out your entire account. I think, is that the point?
Picking up pennies in front of a steamroller, right?
Yeah.
All right.
Yeah.
John Mizuka. Again, I'm sorry if I'm mispronouncing your names. So the roll position, the strike was actually higher than the current stock price. When you roll a position down and out, in that particular case, John, yes, I did roll it at a little bit higher. The reason for that was I wanted to get a net credit on the transaction. If I rolled all the way down to like 27, 26, it would have been a net debit there. Wasn't there some risk of being assigned right off the bat? Yes, although it's relatively low. Early assignment doesn't happen nearly as frequently as people think it does. And if you do get early assigned, you can then sell covered calls even quicker. So it's not necessarily a bad thing anyway. But you are right, it could have early assignment. Jaffe just told me be careful with strategy has the same issue. One loss is hearts. That's right. Some particular positions could be pretty big losses, especially if you do like spreads and whatnot. But if we're just looking simple, selling a cash secured put, you have all the money in the account to make the position. then you won't lose all your money all at once, but you can manage it. Okay, can you close out early at like 50%, ends them in 89? That is one of the main strategies we actually do at Theta Traders. Good point. Buying to close a 50% profit has shown a higher probability of success compared to the initial position. Let's say you had about an 85% chance of success, you buy to close 50% profit. The percent does go up a few percent. I know Tasty Traders did a lot of research on that with SPY. And yeah, that's exactly what we do. Raj, big fan of closing 50%. Seal the win. I haven't heard many people go homeless by collecting profits frequently, right?
Yeah.
Let's see. Yeah, I do credit spreads with delta 0.15. That's a good idea. Yep. I've been doing, and I've been showing on Theta Traders, I've been doing deltas a little lower, like 0.1, even 0.08, just because I don't want to get in a point where the stock price goes lower than the long one. But 0.15 could be good if you're willing to manage them. I wonder if it's better to just do Kester puts at 0.15. No right or wrong answer to that. I'm doing both. I personally do more just cash secured puts. My deltas are usually 0.1 to 0.2 or so. On the very small occasion, I might go a little higher than 0.2 if I'm a little bit more bullish, or if I want to possibly collect premium through the wheel strategy. Question for you, Faraz. What triggered your decision to roll Spice early? Good question. In hindsight, but hindsight's 2020. In hindsight, I should have done nothing because Spice actually did go back up, and pretty sure you actually were able to close that at a profit, right? Which is about a 4% profit in a month. I personally decided to roll it because they already did the news of the flight. The flight went well. The stock continued to drop, and the IV didn't really drop as much as I thought it would have. And for that reason, I rolled it. Again, looking back later on, sure, could have held it, but in this case, that's what I decided to do. Lance, you decide to sell puts as well. Pretty much that's their main strategy, actually. We do sell cash secured puts. I'm not sure what you mean by reverse direction.
Ben that it goes up, right? Ben that it stays high or goes up rather than, I think that's what he means, right? Selling puts, you don't want it to go down.
Exactly. Our main strategy is we're selling cash secured puts. So we own enough money in our brokerage. We're just holding it there to be able to do the put position. And we're selling them way out of the money. Deltas are 0.05 even sometimes, so around 0.2 or so. High probability of success. And then we're going pretty high IVs because we want to get good returns on our money. Every trade I do is a minimum of 4% a month. And sometimes you could buy to close it early. We did one on QS last week that closed in 2 days on a monthly. So we're able to receive a bunch of premium there. And when we get assigns, we sell covered calls, do the wheel, or might decide to roll it.
Cool. So I have another question from a guy in Sidekick. Are you done with the questions?
I think those are the questions I see on the comments.
Okay, cool. So so this one was from DC Melman in Sidekick because he can't make it to the thing. So I don't know if you just seen it pop up. I just copy pasted it in.
Okay. Other than doing the math, what methods do you use to keep track of your cost basis for trades when you get assigned and then subsequently sell covered calls against your new stock position? Okay. Let me share my screen on that one.
Mm-hmm.
This is how I do it. If you join Theta Traders, you'll see the spreadsheet. It has every single position that I've made all year. And you can see it's quite a bit here. Whenever I get a position where I actually get assigned and I sell shares, I'll essentially start writing down the cost basis on these particular companies. So for instance, Rocket Mortgage, I started at 23. That was my initial strike price in the cash secured put. And then I just keep subtracting the amount of premium that I collect. So Rocket, this week, for instance, I was able to buy to close one of my covered calls at like a nickel. And then I sold a new covered call at, it was about $30 or so. So in that case, I just took the $30 I collected, subtract the $5 that I bought. I made a net $25 gain. In this case, the 25 would be added on to this number. I'd add 0.25 to my subtracting premium that I collected. And then the final number is my actual cost basis. Other than doing math, I'm not sure if any brokerages will actually track it for you. Maybe it does. I know some brokers will track the initial price that you collected your shares on. So the strike price minus premium. I know Schwab does it that way, but you could check on your brokerage on that. I'm not really sure. That's a good question if there is a easier way to do it, but honestly, it's pretty quick. Take your initial strike, write down the premium collect, subtract it, and then find your new cost basis.
So there's another one there. Do you stick to the same list and replay the strategy, or do you constantly screen for new stocks?
A little bit of both, but I've been doing, and let me share my screen again. I've been doing a lot of different positions just this year alone. If you join the Theta Traders, you'll receive this ebook that has a lot more detail on the strategy and what we do. On the very bottom of it, here's a list of all the stocks I've sold cash secured puts on just this year. And you can see there's a fairly long list of companies. And I've sold at least one cash secured put on every single one of these companies. Some of them I do go back to pretty much every month or so. A few popular ones, Fubo, Palantir, CCIV. There's quite a few that I'll look back at again and again. But in general, I do look for new positions all the time. And we do use screeners. I do look for positions that might be relatively new to add them on watch lists and whatnot. Okay,
So-
any other, Russell? Do you know?
So you know how I'm very new to selling options. I've been trading for about a decade, but penny stocks, scalping stock alert services and things. So I've only been at this like a few weeks with you. You know, I'm learning it from you. And the only time I've had to do like a covered call, like if you know, I found like it's been the shares that have saved me, right?
Yeah.
It's like I buy 100 shares and then I get a covered call, and the covered call might be a $5 loss as the stock goes up, and then I make all my money back plus more just from the shares. If it, you know,
Yeah.
yeah. So it's like I'm sitting there going, do I really care about this covered call? Because the shares are going to go down so much if the covered call starts to make any money, and the shares may go $50 negative, but the covered call may do $5 or $10 from theta decay or whatever, you know, or just from the price change.
Yeah, it's a concern if the stock keeps falling like a falling knife. You're trying to catch it. It's hard to actually manage it at that point. I don't necessarily look at it that way. I'm just looking at it as lowering my cost basis as much as possible once I get a sign on the stock. Because if I lower that cost basis over and over, I think eventually the stock will rebound. Sometimes you got to be very patient. It could take months or years, but just trying to collect that premium over and over, lower that cost basis, and then I make the trade relatively safer than just waiting for a stock to shoot back up again. There's nothing wrong with your strategy. You could hope that it shoots up to the moon and you'll make a lot of money that way too. But I'm looking for more consistent, very systematic way to earn premiums, and that makes a good return in the end.
Do you see the banners I'm putting up and playing with the new features? I'm loving the software. It's great.
Right. Oh, we just got a new question. Does it matter where you start on the wheel of a cash put or a covered call? Technically, no. I actually started the wheel on Wish, WISH, by writing. So I bought 100 shares and I wrote the covered call right off the bat. I didn't decide to do cash put first. So it doesn't technically matter. A lot of people usually start cash put, but there's nothing wrong with starting with the buy right away. Anyone else out there? Any other questions? That was a good time.
Yeah. how long have we been doing this? It feels like about 40 minutes or something.
Yeah.
Don't see the time anywhere, but I think if that just wraps it up, I mean, we can call it a day. This should be recorded and people can come back and revisit it and reach out to us, and mainly you.
Sounds good. Yeah. So anyone that's watching on Facebook, you could private message me if you want. I'll respond to them. They'll send me these face requests friend requests right away, and I don't know who you are. At least say a quick note about who you are, because sometimes I get other spammers and whatnot. But feel free to leave me a question there. You can leave me a question in any of the comments section of this particular video if you want, and I'll address them when we need to.
Cool. All right. Well, guys, thanks for being here. Thanks for asking all these questions. And I think let's just wrap it up there. And we'll be doing another one probably in a week or two, right? This is the second one. And there seems to be a lot to talk about in this topic, and people are really interested in it. It's becoming more and more trendy.
If people leave any other general questions, we could do another one of these in the future. So just let us know what you'd like more help on. We could do it.
Sounds good. All right, guys. Well, we're going off now, so talk to you guys later in the various rooms and on Facebook that you guys know us from. So we're pretty cool.
All right. Thanks for watching, everyone. Bye, Russell. Bye, everybody.
Cheers, man. Bye.